Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Gino Barbaro. He is an investor, he's a certified money coach, an entrepreneur, and a podcast host. As an entrepreneur, he has grown his real estate portfolio to over 1,800 multifamily units, over $450 million in assets under management. His mission through Barbaro 360 is to empower families to build lasting legacies by focusing on restoring traditional values in family life, finance, and helping families create a healthier relationship with money. He is also the best-selling author of Happy Money, Happy Family, Legacy. So, Gino, I am looking forward to today's episode. Thank
Keith,
you so much.
I hope we can turn the spigot on a little bit to the wealth flow, because you said that last word, legacy, and 20 years ago I thought legacy would have had no conversation in wealth, at least for my story. And now that I look back at it, I think legacy is probably where you should all start if you're going to be considering building wealth. I mean, investing in multifamily for me has been incredible as far as a legacy component, but also a wealth component. So I'd like the listeners just to have an open mind and say, wow, okay, we're going to talk about wealth and how to flow wealth, but I think legacy has to be so important on where you want to go. I mean, we're all starting today. Where do you want to ultimately end up, Keith?
Yeah, I think that's a great way to start the show, actually. And so, why don't we talk a little bit about your own journey? I love to get a little background on each of the guests, and so I'd love to find out, Gino, where did you grow up? What eventually led you to investing in multifamily?
I grew up in New York. I had two amazing parents. They're both immigrants from Italy. And I grew up in the restaurant business. I went to college, but after I graduated college, there was no jobs. I did not foresee myself being stuck in a cubicle for the next 40 years. It was just not in the plans. So I ended up opening a restaurant with the family, and I loved it. Until I did love it. I mean, 2007, my dad passed away, and I always asked the question, was I living his dream or was I living my dream? Because I loved working with the family. I loved the culture that we had. I loved working with that small-knit group of people in the business, in the restaurant, but I just got burned out. I just didn't know how to scale. I wasn't creating wealth. I was working harder and making less. I'm sure a lot of people can sort of resonate with that. And that's when I said to myself, what's the next thing that I need to do? I picked up T. Harv Eker's book, The Secrets of the Millionaire Mind. And when I read it, and I got pretty annoyed at T. Harv at first, but then I had to reflect and I had to say, your fruits are in your roots. And I had really shallow roots. And to me, that meant my fruits weren't going to be there. I didn't have enough ability to provide value for others in the marketplace. And that was the reality, Keith. That was the turning point for me. And I said to myself, I can't scale this real estate thing. I need more clients. I need more customers. I need to create more value. And I just loved multifamily. I said, let me figure a way how to get into multifamily, because I had already done those other niches. I had gone into mobile home parks. I did a bad job. I had gone into strip malls. I didn't like that either. I liked the customer service of multifamily. I liked the residents. I liked the fact that it was a basic human need. That all served me well, and I could see a path forward that way. And when I met my business partner, Jake, back in 2009, he was a drug rep, pharmaceutical rep, taking catering orders out of our restaurant and bringing them to doctors' offices, he was sort of stuck in that hamster wheel as well. He saw no future in healthcare and working for a company like Glaxo long term. So we partnered up and, I had sort of the skill set. He had sort of the ambition, the sweat equity, the market, and we partnered up in 2011. And 18 months later, we found our first deal together.
Yeah, that's fantastic. And so tell me a little bit about that first deal. So you'd already taken a stab at many of the various asset classes within real estate, and kind of gravitated towards multifamily. What was the first deal that the two of you did together?
Keith, that is an understatement. I took multiple stabs into multiple niches. And I have to say, it's not the niche where I messed up in. And people are going to blame, well, RV parks or self-storage is not a great niche. If you really understand the niche and become an expert in that niche, you're going to do well. I was not an expert in mobile home parks when I invested. I was less of an expert in what a syndication was. I wasn't even less of an expert in how to underwrite or how to buy a mobile home park. So it wasn't the niche itself. I just liked multifamily. I don't know why. I just liked the fact that it was monthly recurring revenue. People needed that place to live. I didn't like retail because I was coming out of the 2008 cycle where all of a sudden there was a lot of vacancy. I didn't want to have a strip mall that was dependent upon, businesses and the business climate. And for some reason, I heard this thing called the internet, and I was just afraid that it was going to affect retail. So I said, you know what? I want to push away from those. And when we looked at multifamily, for me, I just wanted to start in a market where I knew there's population growth, people are moving. I was in New York. I just did not like the demographics in New York. I didn't like the taxes. I didn't like the insurance. Fortunately for me, Jake moved to Knoxville, Tennessee, which at the time, I have to be honest, didn't even know where it was. I couldn't find Knoxville on a map 15 years ago, but I get lucky sometimes. He moved to Knoxville. We started looking, and that first deal for us was phenomenal. Once again, the first deal that I did by myself was the mobile home park. And now the difference between that very first deal and the first deal that Jake and I did was I had a process with Jake. I had a map. I had something where I could actually formulate a business plan, whereas I didn't have that before. I ended up getting mentored right after I read T. Harv Eker's book. I went and found, Rich Dad, Poor Dad coaching. I worked with Dave Lindahl's group. I worked with a gentleman named Craig Haskell, the Value Hound. He passed away several years ago. But I really dove into that part of personal development and part of learning that real estate's a business. Whether you're investing in it passively or actively, most investors, especially early on, don't understand that real estate has systems and processes built in. And if you don't buy the asset right, if you don't finance it right, and then ultimately our third step to our framework is if you don't manage it right, if you don't do those three in conjunction, you're not going to have a very stable investment. And you've seen over the last 5 or 6 years, people were buying them properly, they were financing them, but there was no management. And now over the last few years, what you've seen maybe some buying right, but not really. Managing, no. And with all this bridge debt, it's starting to come due right now. You're seeing that they're violating the principles of our framework. And I was early on a culprit of doing that in the mobile home park space. And that framework, you can take it to investing in businesses, buying single family homes, multifamily, whatever it is. But if you can follow those principles of buying this asset properly, financing it properly, and then ultimately setting up KPIs and systems within that investment, you're going to have a much higher chance of having a profitable investment.
Yeah, makes total sense. And, a lot of times, unfortunately, we learn along the way. And
Yes.
I think some of those recommendations that you have are certainly great. You did them yourself. Both Jake and Gino are known in the multifamily world and mentorship world, and so would love to maybe have you expand a little bit on, kind of that buying it right and, what you look for with your students, with yourself when you're doing various, when you're purchasing. What exactly are you looking for to make sure that this is going to be the right deal for you?
I'm going to sound like a lawyer. And the answer truly is it depends.
Yeah.
And the reason why I say it depends is it really depends upon the function of where you are in the market cycle. Our buy right criteria back in 2011 and 2012 is a lot different than it is now. We're in a different part of the market cycle. I wish I had known that early on. Everyone's like, buy and hold, market goes up forever. Yeah, that may be true, but you can always buy real estate. You can't always sell real estate. That's one of the biggest lessons that I learned early on, understanding what the exit strategy is. So when you're thinking about the buy right criteria, I'm going to talk about this specifically in multifamily, but you can use this whether you're buying a single family home or a mobile home park or any niche. You need to have a specific buy right criteria. And to me, this was incredible. I was at an event a few years back. It was an event full of syndicators, and I asked the crowd, does anyone have a buy right criteria? And they all looked at me with like deer in the headlights. And I'm saying, wow, these people are raising capital and they're just raising capital to buy deals and they have no specific criteria. They're like beginning investors where just give me a deal. Well, a deal to Gino with experience is a lot different than a deal to Gino who has no experience and who has no capital. So to me, it was mind boggling. When I first started with Jake back in that early part of the beginning of that market cycle, you're looking for older assets, a lot of value add. You're looking to possibly, flip those deals, and or if you like the deal, you're looking to hold that deal for longer term, right? You're looking to refinance that deal. Ironically enough, the deal we bought in 2013, that very first deal, we still own that. And it's interesting because we own it because we love the part of the market. We've just recited every single building on that property. We love where it is. We love the median income of the area. We love where rents have gone. We love the type of asset that it is. It's an affordable type of asset. We love the cost segregation that we still have on the asset. We love the cash flow. So understanding what you're buying in the market cycle. Now that deal today, I would not buy that deal today unless I bought it at a material discount. I'm not buying a 1960s asset in this part of the market cycle at a 4 cap. You could do that 4 or 5 years ago, but a 4 cap now is a foreclosure because rates are at 6 or 7. You're buying with negative leverage. Back then, we were buying those assets at 10, 11, 12 caps going in actual. It was great. But when you go back, Keith, what happened back in 2011 and 2012? The economy sucked. You couldn't raise any money. There were deals everywhere. It was a different part of the market cycle. So that's when you load up on these value adds. That's when you load up on these properties where you can really push rents and get that material value up. Whereas now in the part of the market cycle where we are now, when you're creating a buy right criteria, think of first and foremost, what market are you in? We're in the east part of Tennessee, Knoxville. So we love Knoxville. There's certain markets where we won't touch within the city of Knoxville, but we understand where we are in Knoxville. Then the second thing for us is median income. I mean, what kind of median income? If you're looking for renters that are going to pay $1,000 a month, well, and the median income is only 25 or 30 grand, guess what? They're probably not going to be able to afford your rents. So understanding what asset you're buying is important. What's the median income? We like at least $50,000 where we are in our market. And certain markets, you go to San Francisco, 50 grand is a joke. But maybe certain markets of Alabama, $50,000, you're a baller. So understand where you are in the market. I think the next thing is the age of the asset. We like anything that's mid 80s and newer, 90s and newer would be great. And ironically, our last 3 assets that we purchased was a 2018, 2019, and a 24 build. So the last 3 assets we literally bought from a builder who's having problems leasing up. That operational, that management component, there's the value add. That's where we are in the market cycle right now. It's not just valuation through renovation, it's valuation through operation. That's something else that we're looking for in this part of the market cycle. Amenities, washer, dryer hookups, we love them in our part of the market. And in the type of assets that we're buying. We love 2-bed, 1.5 bath townhomes. Those are great in our market. If we can find 3 bedrooms, even better. Now, that's not to say that I'm not going to buy assets that have only 1 bedrooms, but we're going to pay a material discount for those because they cost almost as much to run, but yet the delta between rents between a 1 and a 2 bedroom can be $200 to $300. So it's very interesting. You need to understand and become an expert in your market, what income versus expenses are in the assets. So as you're seeing me throw all this out, think of yourself in your market. What's the age? What's the median income? The location, the unit mix, the amenities. All of a sudden you start painting a picture, and from that picture you can convey it. to brokers. You can convey it to, property managers. You can convey it to investors. And all of a sudden you get a crystal clear picture of what you're trying to buy. And it's okay if something else comes that doesn't fit that criteria. Just like I said, make it according. I'm not going to pay a 5 cap for a 1970s build, but maybe I'll pay a 9 or 10 cap. Is that seller willing to sell it at that price? Great. And then as the market cycle shifts, you have to be cognizant of that and understand, well, you know what? This criteria that I have right here needs to be tweaked a little bit.
Yeah. Okay. No, that's great information for sure. Now, you started in the Knoxville area, and you mentioned that a couple different times. Where else? You guys have 1,800 units across the U.S. right now, or approximately, right? And so, what area is it that you are purchasing?
Keith, when we started, we just wanted to have our own property management company. We wanted to manage our own assets. So we started from the very beginning, managing our own deals, and we became vertically integrated. So as we started buying, we wanted to stay within a 2 or 3 hour radius of Knoxville. That's what we felt comfortable with. We were in Morristown, we're in Jefferson City, Knoxville. We have not been able to buy any deals in Chattanooga. Don't know why. It's been a difficult market to break into. But then when we started syndicating and raising capital back in 2018, we decided to go to Louisville. So we bought 2 assets in Louisville, and we bought an asset in Lexington, Kentucky. And the syndication model worked for us because it was like a bridge. We had done deals from 2013 to 2018 with our own capital. We were able to refi a lot of that capital and put into the next deals. But at a certain point, Jake and myself and my business partner, Mike, we ran out of money. And we're like, hey, let's start syndicating. We got through that little, couple year window where all of a sudden we were able to recapitalize, and we said to ourselves, these syndications, it's a different model. There's an IRR component. It's not our capital. We need to do what's best for our investors. We don't like having hundreds and hundreds of investors. We'd rather have the capital to ourselves. So we actually started selling out of those assets, and we actually, I think mid-2022, we sold our last syndication. So, from then on, we've just been able to fund deals by ourselves. So I love syndication. It's an amazing tool. It's a great tool to use if you don't have money. But at a certain point, I just said to myself, it's another business. We have to manage investors. We have to manage all of that. If you can do it on your own, and you may say to yourself, well, I won't be able to close 700, 800, 1,000 units in a year. And that's okay with us because our biggest metric that we focus on is PPU. It's profit per unit. We want to become as profitable as we possibly can with our portfolio and not worry about anything else. And if that means, hey, sacrificing size and now outgrowing our infrastructure and managing what we have, that's what excites us, and that's what we want to focus on.
Okay. Yeah, that's really interesting. It's interesting that you went down that path, which is pretty typical. Oftentimes people start with their own capital, then they go to syndication, and they grow from there, but then they continue syndicating. And it sounds like you've pulled back a little bit and said, you know what, we can actually accomplish this on our own now that we've got some money to play with. And obviously, then you don't have, like you said, you don't have all those other people to speak to, because you mentioned still having that initial asset. That'd be pretty difficult to do in a syndication, right? Somebody's going to want to have their exit at some point, depending on who your investors are.
It's unfortunate because if you're a true investor, and if I'm coming to you with a deal and I'm saying to you, I'm going to present this deal for you, and within the next 3 to 4 years, possibly, you can have recouped most of your capital. You can stay in the deal. You don't have a taxable event. And the capital that you have, you can go into another deal. And we're really building this thing, and we're going to get some type of economies of scale. So it's going to be cheaper to run the successive assets, and you're going to be continuing to build. And at some point, you're going to have a lot of your capital back, and it's going to continue to grow. And there's this snowball effect. To me, that's like nirvana. Why am I killing the golden goose? I've got this goose that is laying eggs. Why would I want to exit out of that? Now, I understand that people want to velocitize their money and get in and get out. The problem with that is now it's pretty hard to find a deal. I'm so thankful and fortunate that we've held on to the majority of our assets because I've interviewed hundreds of people. And, I forgot what this gentleman's name was. He wrote this red book on syndication. And 2 things, he said the 2 biggest mistakes that he made, Sam Freshman is his name. The 2 biggest mistakes that Sam said he made was he didn't buy enough and he sold too soon. So when somebody in their 80s is telling you that, you need to have the wisdom to understand to say, well, if he's telling me that and he is super successful, I think I have to look into that model. And for us, it's all about buying the right assets. Not every asset, deems it worthy to be held for the next 10 or 20 or 30 years.
Right.
For where we are in our market, we think our market is very healthy, very robust. It's still a path to progress. So there is still an abundance of jobs and population growth. So we don't mind holding these assets. But at the same time, if we see another opportunity, we will sell out of that asset and roll it into a different opportunity. So you have to have an open mind. But I think people go into real estate thinking that, I'm going to trade up, and it becomes more of a hamster, another type of hamster wheel. For us, we just looked at it and we said, I don't want to continue to feed the beast with these investors. I don't want to be forced to do a deal, because when we got into 2020 and COVID shifted, the deals were a little bit more challenging. I didn't want to go out there and force a deal and say, oh, we got all these investors, we have to continue to grow this. We have to continue to collect some type of fees. We have to feed the beast. And I didn't want to fall into that, because I had made mistakes in my previous life before I met Jake, where I was sort of forcing myself to do a deal. And when you see yourself forcing to do something, when you see yourself pencil whipping deals just to, make investors happy and just to collect some fees, that's when you're going to start making big mistakes. And I wanted to avoid that.
Yeah. It makes a lot of sense. And there's so many people that did, and as things got tighter and tighter, it's just manipulating the different pro formas to somehow, makes enough sense that you can be okay with it.
And Keith, for those of you that did that, it's okay. You've lost money in real estate. Right. If you haven't lost money in real estate, then you haven't done real estate. I mean, my business partners are very fortunate. When he met me, he was a novice. I was the one who had all the battle scars. So he can technically say that, yes, he's lost money in real estate because I lost money in real estate. But for those of you there, you may be going through some really difficult times, some really challenging times. I was going through that in 2008 when I bought at the wrong part of the market cycle, wrong market, wrong asset, wrong debt, and I survived only by understanding that, wow, God put me through a ton of these problems. I can sit here, I can sulk, or I can go back and read T. Harv's words and say, where are the opportunities that are coming from these problems? And I saw a lot of opportunity, ultimately, that I had the fortitude to go through these. So if you're going through that right now, you're not alone. Every real estate investor, I should say almost every real estate investor that I've talked to has lost money at some point. Losing the money is not the problem. I think quitting and saying, hey, I'm going to give up, that is where the problem comes in.
I agree. How about, let's talk a little bit about, you've mentioned 2008 and kind of going through that. And, obviously we had this run up with interest rates, and, now they're coming back down. But there was this hot part in the market where cap rates were compressed. And, you talked a little bit about some of the bridge financing and stuff that got a lot of people in trouble. But where do you see us right now in the market? What, obviously neither one of us has a crystal ball, right? But it's always good to just hear, especially from somebody who's been there and gone through several different cycles. Love to hear your perspective on where we're sitting with the market.
It's so challenging, Keith, because I've been struggling the last few years to understand the data. The data doesn't make sense. Can we trust the data? The Fed's been late to the party. I mean, should the Fed had cut rates sooner? Probably. I think right now, the single housing market is very interesting right now, because rates, the house prices jumped so dramatically, and you can understand that. It was part of the interest rate cycle. Money was so cheap. The cost of capital was so cheap. Everyone flowed into the asset. And that's what you're seeing right now. You're seeing just a stall. It seems as if deals aren't being done unless you have to do a deal. People are on the sidelines. I think banks are probably healthier than they were back in 2007 and 2008. If that was the case that they weren't, we'd be in more, for lack of a better term, shitstorm right now, and we're not. Right. That's really saved us. I'm looking at Bitcoin today. You see what happened to Bitcoin? Bitcoin's still up, I think, 20% from November of 2024 till now, but it's down like 30% from where the high was. So it's one of those things where if you're sitting there short term and trying to understand where the flow of capital is coming in, and you're trying to time the market, you will never be able to time the market. The only way you can time where the market is high is, you look back and go, the market high was in November of 2022. We know that multifamily peaked back in 2022. I think if rates continue to stay where they are, and I think they probably will, it's just going to be sluggish. And I think if banks are willing to say, hey, we're going to stop kicking the can down the road, we can't deal with this restructuring of debt, there's going to be operators out there that need to sell these assets. That's what it ultimately comes down to. And Keith, I think another component that nobody can, give me an answer or conventional wisdom, where are we with the economy? I don't know how we added 100,000+ jobs last month, and I don't understand how the GDP was up 3.3%. It doesn't. Those numbers just don't compute with what I'm feeling right now. And perception is reality to me. It doesn't feel that way. So I don't know what to trust in the numbers. All I know is that in the long run, for us, I think multifamily is going to be okay. But in the short run for us, I should add this as well. Rents have dropped. And that's why it's so tricky to be the Fed right now, because is there inflation? I mean, if there isn't any inflation, you should be dropping rates. And rents have dropped for the first time in a long time. And we know that because in our market, we have such supply coming online that the demand is there, but it's got to work itself through. And those older assets, those 70s and 80s are competing right now. And you're saying to yourself, well, rents, where are they going to go? Our rents in Knoxville over the last 5 years, I think, have averaged like 7% growth in a tertiary market. But right now, last 12 months, we're down 1%, 2%. Occupancy was 95, 96. We're in the low 90s right now. So I'm just telling you where we are in the market. I'm hoping that this supply gets taken up, all these deliveries get absorbed. And once that happens, there's not going to be as many deliveries coming on board. Rent growth starts up and there's more positivity. Just be careful. If you're underwriting deals right now, in my opinion, there is very little rent growth right now. And do not be cheap with your expenses. I can't believe how much expenses has exploded over the last 4 years. Because all I hear is people talk about how much rent has gone up. Yeah, rent's gone up. I guarantee you it's gone up a lot. But on the expense side, between taxes, insurance has doubled in a lot of markets, and repairs and supplies, that's really come up. So when you're underwriting a deal, make sure you get with a property management company and underwrite the asset to what the expenses per unit are. Don't be liberal with those expenses. Make sure you underwrite, and make sure you underwrite conservatively.
Yeah, I think that's all great points for sure. How about tell us a little bit? Let's maybe shift gears a little bit, Gino, and talk a little bit about your book, your philosophy when it comes to not only money but also legacy. I think that'd be a good spot for us to kind of talk about for now.
So for me, I have 6 children. The oldest one is 26. My youngest is 11. And I've been on this money journey for so many years, from the restaurant, not having enough, and then getting into real estate, and then becoming successful. And now I've got money. But how do I raise my children around money? How do I make them not feel entitled? How do I make them feel a part of this? How do I teach them? How do I make them become financial stewards? And that's where you're talking about the legacy component. And for me, it's so important if you're an entrepreneur and if you're a person with money, we all need to talk to our children about money. Your language becomes your experience. And for me, it really dawned on me about 10 years ago. My son, he was about 16 years old at the time. He started investing in real estate with me. I let him put his money into a deal instead of buying another amplifier that he didn't need. Fought, bemoan, 6 months, had him finally invest his $5,000. But what ended up happening was he had skin in the game and he started learning from it. Instead of me just telling him and me just letting him, this is what you need to do, I let him become part of the experience. And to me, that was life-changing. And then I started Jake and Gino. They became part of that company, and just letting them in, letting them come to the events, letting them be part of the company. That was another component for me of legacy. And then ultimately, this last shift that we've had, we've created a company called Barbaro 360. That's the family company where my son and I are doing a podcast. My wife and I have continued to do a podcast. I've written a book, and that's really what legacy to me is about right now. It's about the family coming together, the family having these values, sharing these values, perpetuating these values into the next generation. I mean, legacy is like a gardener who plants a seed. That gardener may not see that seed grow, but he knows he's planted it, he's watered it, and he's hopeful that the generation that he has now will take care that seed into the next generation. And as you're buying deals and is creating all this wealth, just stop and say to yourself, is that what I want to do? Is that what I want my legacy to do? And I could have stopped and continued to do real estate, but at a certain point, the ROI was not there anymore as far as enjoyment, as far as passion. And that's when I said to myself, well, what does legacy look like? If I could include my children, if I could teach them about money, if I could have them become financial stewards of the capital that we're creating, if I could have them become a part of it, that would be amazing to me. And my kids have really loved the whole process and the journey. And for anybody listening, legacy, what does legacy look like to you? To me, that's what it looks like.
Yeah. No, that's great. That's fantastic to have. What a tremendous lesson too for your son. On the first deal, just being able to. What did he see on the growth of that 5K that
Keith,
that he put in?
You know what's incredible? That 5K that he put back in 2016, he's got a mid 7-figure net worth now in that deal. Because
Nice.
we bought it. He had 1% ownership. That deal that we bought, we ended up selling 2 of the assets out of the 150 units. So we ended up selling 2 of those assets. So he got money there. We've refied that deal twice. Every deal that we went into, he'd refi the money. He'd put the money back, which was actually very interesting. The mindset was, now I have money. He actually has his federal firearms license also at the age of 23. So instead of saying, well, I've got money in the bank, I'm going to go buy a gun, he goes, Dad, no, I've got money in the bank. When's the next deal coming? The even more beautiful thing about it was his language changed. All of a sudden, he knew what an owner draw was. He knew what economic occupancy was. He would ask me, Dad, why didn't we cash flow this month? What's going on? How many turns are we doing this month? All of a sudden, the mind shift changes, the language changes, and the expectations change. And that just happened organically. That's because he had his money at play and he was very interested in how to grow that money. And then obviously, I'm there. I'm the adult. I'm helping him along the way. I'm trying not to tell him what to do, because at certain times you want them to figure it out. But at the same time, I want them to sit there and I want him to have an understanding. And while he's doing that, I send him off to college. I make sure that he becomes, an accounting major, so he understands profit and loss sheets. He understands balance and debits and credits and income statements. So that part of the journey going to college was important for me. But then being part of the investment, I think to him it's been life-changing for him.
Yeah. No, it's neat. It's neat to have. I mean, I think as parents, we always want, it's always, especially for entrepreneur parents, it's something that you kind of want your kids to, have more interest in dad's business or mom's business or whatever it may be. And we don't always get that,
Yeah, but Keith, what's really cool though? I have to say, my 26-year-old she went to college. She majored in philosophy and theology, and she became a missionary. And she loves that. And any advice for parents, just let your children decide what their passion is. I know as an entrepreneur, I want my kids to take over the family business. Right. But what's really cool is about 6 months ago, she turned and said, hey, Dad, I think I'm an entrepreneur. And I said, I know you're an entrepreneur, because missionaries, what do? They want to actually go out and they want to share the message of God. What do you need to do with that? You need to actually try to convince people or share your beliefs and try to make them understand and try to get them to accept that, or actually to understand what the message is. And then on top of that, you need to raise money for the mission. So all of a sudden, you've got sales skills going on. You've got a little business going on. Now she's producing a movie with somebody. So it's interesting how if I had told her you got to go into real estate, she would have hated it. She'd probably hate me. It's not her passion. But now she can find her passion and what she loves to do. And as we've grown together, she's learned some entrepreneurial skills, the cadences of accountabilities, the rhythms, the way you talk about money, the relationship that she has with money, and all those systems, and she's bringing it to what she loves to do. Yeah.
No, that's great advice, and I think that's it's probably true. At some point, they've ultimately got to be the ones that make the decision there.
Yes.
And it's neat that your son did and got involved as quick as he did. But sounds like your daughter's kind of coming around to the ideas as well. So that's awesome. And tell me a little bit about this new company, Barbaro 360. You mentioned your wife as being part of it as well. Has she always played a role in your businesses as well? I mean, obviously, as a couple, I'm sure she was there to support you, that kind of thing. But has she always played a role in the businesses?
Well, early on, you know, we were one of those families that started homeschooling 20 years ago. We were the weird kind of people, right? And it just worked for our family because I was working at the restaurant. I was working weekends. The kids would be off on school for the weekends. So we're like, listen, let's homeschool. So from that perspective, I was a breadwinner. She stayed at home. But around 2011, we just had the urge to write a cookbook, start doing some videos on YouTube, and create a company called Gino's Family. I think from that point on, she also, I personally think the moms are the ultimate entrepreneurs. I think they have the toughest job. I think they've got to wear multiple hats. So their job is so diminished in society right now. But if for somebody who has had to figure it out, whether it's kids are sick, being a chauffeur, being a chef, I mean, like balancing the books, whatever it is, it's just been incredible to watch that part of it. But for her, the last 5 or 6 years, she's really transitioned into becoming a coach also. She saw that what life coaching did to me. She was resistant at first, but then she went all in. She's become a high performance coach. She's become a money coach with me as well. It's been really cool to see that growth together. And then as the kids see that, they're like, well, mom and dad are working together. They see what a healthy relationship looks like. And for us, we're able to balance our skills together and work really well together. So if you're out there and you're saying to yourself, I can never work with my wife, I would challenge you. There's a lot of limiting beliefs there. If you're married and you're together, I think you can just sit down and find out what each of you loves. Because my wife told me when we started our first podcast, she's like, I never would have ever dreamed in 100 years that I'd be in front of a microphone talking to people. And it's one of those things where, you know, she's with me and we're doing it together. And that's the beautiful thing about partnerships, whether it's myself and Jake or myself and my wife or the kids. It's so much more fun to be able to do it with other people because at times it does get lonely. There's no one else you can talk to.
Sure.
You've got to make payroll. None of your friends, none of your family members really know what that is. But hey, you got your buddy Jake where you can talk to him and figure things out, or the wife. I think partnerships are wonderful and I love having them because I know that I'm not doing it just for myself. I can let myself down, but I will not let Jake or my wife or my kids down.
Yeah. Yeah. No, I think there's something to be said about that for sure. It is a lot more fun when you have people to do it with. What about this certified money coach? I hadn't seen that before. I haven't heard of that kind of certification. Tell me a little bit about what all that entails.
There's a lady named Deborah Price. And the reason why I got into it, Keith, is I have this Jake and Gino community. The students are crushing it. But the problem is not everybody's crushing it. I've got Keith, who's good looking, young. Keith shouldn't be doing deals, but he's closing deals. How is Keith doing that? Then I've got Gino over here, who's older, has a strong balance sheet, should be closing deals, and he's out there complaining that he can't do deals. Now, what's the difference between these two people? And it really baffled me for so many years going through the Jake and Gino community because our fulfillment is phenomenal. We had 4 events a year. We had great vendors. We had great education. And it dawned on me, it's a person's relationship with money, their psychology of money. I read Morgan Housel's book. I thought that was phenomenal. Then I went down the rabbit hole. Is anybody teaching money from the perspective of not 1 + 1 is 2, the financial aspect of it, but the psychological aspect of it? And I stumbled upon a lady named Deborah Price. She's been doing this for 30 years. She was a financial planner who basically said financial planning is not hard. It's not rocket science. It's basic math. Why aren't people sticking to the plan when we put it together? And it ultimately came down to, you know, our patterns, our behaviors, our beliefs about money are inherited from our family members or from our past. And I was like, wow, that makes a lot of sense. As a young person, a lot of us have traumas around money that we bring into our adult life. And if we don't understand for those traumas, if we don't heal those traumas, or if at least we're not aware of those traumas, then things will hold us back. And for me, early on, I was a saver. Man, I could save money, but I was very brought up in a place of fear around money, about scarcity around money. It was incredible to me once I realized it. I had one restaurant for 20 years. But then when I met Jake, within 5 years, we had over 1,000 units. I mean, what's the difference there? To me, it was incredible. And I think it ultimately came down to my relationship with money. My limiting beliefs that I had were ultimately crushed. Takes money to make money, but it doesn't have to take my money to make money. You don't have to be afraid of money. You don't have to be scared of money. There's a lot of fear. All of a sudden, once I started exploring all that, everything changed. And that's what I love about money coaching. I'll just tell you the process really quick. If anybody wants to start diving into it, really go into the past. It's like almost like going into therapy for 1 or 2 sessions, seeing what happened in the past, acknowledging it, understanding where your beliefs and your patterns are, bring it to the present, understand that, and then start creating a path to the future. Whereas life coaches, we like to look forward. We don't really like looking back that much. And therapists sometimes want to stay in the past for a little too long. We dwell on our problems. You need to combine all of that. And by doing a money bio, by understanding what those circumstances, the things that you heard growing up early on, that may shed some light onto why you're doing what you're doing with money today. It may have nothing to do with what's going on today. You just may be pre-programmed from 30 or 40 years ago, and you're still acting upon that unconsciously.
Yeah. I think it sounds like a great process. It really does. I mean, we all kind of come up with certain beliefs related to money, and it could be our parents' beliefs. It could be things that we experienced early on when we were trying to make it. And so I think that's a good, sounds like the right place to start. Is kind of going back to that and then formulating now that you know that, where do you want to go? And what do you want to change about your belief around money?
Yes. And then Keith, one last thing I'll say is if you've got a spouse or significant other, it's very interesting to see that most of these fights that we have about money really aren't about money. We think they're about money, but that's just a symptom. There's something else going on. And what I would say to anybody, I challenge them because this is really hard. Go to your spouse, your significant other, and ask them, how did they grow up around money? Try to really understand from their point of view. Because if your wife grows up around money, as my wife did, single mom, 2 jobs, 3 kids, lived week to week. They didn't have any plans. She said when she married me, goal setting, like building a business, making money, that was so foreign to her. And I was from the opposite, where like, we need to save money. We need to build a business here. You can see the conflict that we're going to have around money. She wants to spend and I want to save. And I'm not saying one is right, more right than the other, but if you can understand from where each of you are coming from, the perspective, then you can have open dialogue. Then I can say, hey, Jewel, I'm really afraid. We've got a lot of kids. I really don't want to waste money. She can understand that and go, okay, we're not going to waste money. Let's set a budget. Let's try to figure something out here. Instead of saying, no, we're not spending money, and her saying, yes, I need to spend money. Having that understanding where you're both coming from changes the dynamic, and you can start having open, honest communication. And I think ultimately what you're trying to accomplish with your spouse is what Deborah calls financial intimacy. If you can have the financial intimacy with your spouse and be able to share your dreams and put your dreams together with her, man, it's a lot easier. Those conversations become a lot easier. And then all of a sudden you start planning goals and you start having a vision that's complementary to the both of you.
Yeah. Yeah. That's great. No, it's really good stuff for sure. How interesting. And I've seen that in my own life as well. My wife's family and kind of how things that happened there financially, got us where we would have maybe arguments around money because I saw something different, and we just had to talk through it. There was a fear for her about, doing certain types of investments because of something she had seen in her own family's life. So kind of an interesting deal. How about, first, why don't we start with really, Gino, where can people find out more about you? And what's the best way to reach out to you?
Barbaro360.com, Barbaro360.com. And you can go to jakeandgino.com also. That's where we have all of our podcasts.
Okay, fantastic. And are you guys still doing anything with Jake and Gino as far as like mentorship, that kind of stuff, or have you kind of
Jake and Gino, no mentorship? Like I said, I really wanted to transition over into this money coaching, this family business. We're creating a media company because I think that's where I was just talking about my kids having a passion. That's where ultimately I see the passion. That's ultimately the legacy that I want to leave.
Yeah, fantastic. And then I've got a couple more questions that I ask every guest. And one would just be, any advice you would give somebody who maybe they're just starting out in their, career as far as investing and finances. What kind of advice would you give them as they're starting out?
I think 2 things. Number 1, have the grace or patience with yourself. When you're out there, you're seeing these people in their 40s and 50s that are multimillionaires. It's taken them a while to do it. Have the grace. And the second part is what Morgan Housel says in his book, The Psychology of Money. If you're not able to save money, you won't be able to invest. I think first and foremost, you need to save and you need to spend below your means. Becoming wealthy is not really that difficult. If you read The Richest Man in Babylon, they lay it out there. It's not sexy. It's not really that difficult, but there's discipline involved, there's foresight, there's playing involved, and there at times it can appear really, really challenging, but the principles are really not that difficult.
I agree. Yeah. And it does take that discipline. And you're right. Savings is certainly one of those foundations it starts with. So, how about a book recommendation? We've talked about several books as we've had our conversation here, but what about a book recommendation? Doesn't have to be real estate or even finance related, but it certainly can be just something that has been impactful for you.
I'm an old disciple of Stephen Covey. I read his book years and years ago. Didn't have that big of an impact, but when I read it again, his laws, his seven habits, they're just incredible. Once again, the simplicity of them. But if you're able to really work on them, it's incredible. And the other thing is, I was at a mastermind a couple weeks ago, and I heard Hal Elrod speaking. I had Hal on our show a few years back, and he wrote a simple book. It's The Miracle Morning. If you've never read it, checked it out. It is incredible. And my morning routines has sucked the last few months, and it's incredible. Like I said, God put him in my life a couple weeks ago. I'm like, this is great. This is exactly what I need right now. I need a framework when I get up in the morning for the first 30 minutes of the day. I need to set the stage for the rest of the day. So if you're struggling with your morning, you're not a morning person, go check out Hal's book. His book, Miracle Morning, is phenomenal.
There you go. Two great recommendations. Well, Gino, this has been awesome. I knew it would be a good show, and I appreciate you being a guest on The Wealth Flow. I think we'll call it a show.
Thanks, Keith.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.